Home sales in the United States on a year-over-year basis have crashed to levels not seen since the 1980s. Now we're beginning to see that appear in actual housing prices, with the first quarter of 2023 printing the first decline in home prices since COVID. Demand for housing, home sales is a massive driver of economic growth and actually directly predicts by around 10 months S&P 500 earnings, and therefore the housing market has a big influence on S&P 500 returns. That also makes sense from a logical standpoint. The more homes are being sold, the more people are going to need to buy new furniture, new TVs, a new fridge, and the list goes on. And when nobody is buying a home, you get the exact opposite phenomenon. So housing is a big driving factor of the corporate business cycle. So I'm going to show you what the housing weakness that we've seen over the past year in the US means for the economy, for stock market returns, and of course, whether or not we should be expecting a big housing recovery anytime soon. By the way, we are doing a discount throughout this week where we celebrate the Independence Day in the United States. We're giving complete access for discounted price on all the services that we provide on gameoftrades.net, and this will be the last chance to get such a cheap deal. As I mentioned over the last week, we will be increasing our prices on our memberships on July 10th. So if you want access to what I think is the highest quality investment research available online, and you want that at a ridiculous price, now is your chance. Welcome back to Game of Trades. I hope you guys are going to enjoy this video. If you do, don't forget to click on the like button down below and subscribe to the channel if you haven't already done so. Now, without further ado, let's get right into it. Now, believe it or not, housing is actually one of the first targets of Federal Reserve monetary policy. So when the Federal Reserve tightens monetary policy, one of their goals is to slow down the housing market. Now, believe it or not, one of the first targets of the Federal Reserve is actually the housing market. When they go on a big tightening cycle, one of the things that they're targeting is to slow down the housing market, to slow down the economy and bring inflationary levels back down. They do that by raising interest rates, which directly impacts mortgage rates. And you can see this chart actually shows you the relationship between mortgage rates and existing home sales. Now on this chart, existing home sales is inverted, it's reversed. So you can see as mortgage rates are rising, existing home sales decline. And when the Federal Reserve eases monetary policy and mortgage rates begin to go down, that's when housing begins to boom, as you start to see a lot of people buy homes. Now, what we saw throughout 2022 is one of the most aggressive tightening cycles in history. Now that's behind us, and it actually led to the biggest weakness in existing home sales since the 1980s, at least on a year-over-year basis. You can see 2022, very aggressive tightening cycle, very aggressive decline in existing home sales. Now, as I said, that is now behind us, and you can see the rate of change. This is all on a year-over-year basis. The rate of change of mortgage rates has been coming down. They're still rising, right? They're still above zero on a year-over-year basis, but they're not rising as aggressively as before. So what we can say from this chart is the rate of decline in existing home sales has very likely peaked in 2022. Now, if you look at what is currently expected from the Federal Reserve heading into the end of the year in terms of monetary policy, we're currently at a 5 to 5.25% interest rate on the federal funds rate. By December of 2023, if we take a look at that, the market expects that the Federal Reserve is going to be sitting around 5.25 to 5.5%. So the Fed right now is not going to be cutting rates into the end of the year. And so while the rate of decline in existing home sales has probably peaked, it's unlikely that we're going to see mortgage rates really decline on a year-over-year basis, right? And I can show you that on this chart, the federal funds rate in black and mortgage rates in orange here. We really need to see a recession for mortgage rates to begin declining. So unless we get a recession sometime in the next few months and we start to see the Federal Reserve really begin to ease monetary policy, it's unlikely that we're going to see mortgage rates decline significantly because the Fed is not going to be cutting rates in the current macro environment. Now, what does that actually all mean for the economy? This chart really shows you why housing is a massive driver of the business cycle. You can see, you take a look at multiple different factors: exports, government expenditure, consumer spending, business inventories, business investment. The factor that weakens the most in the year before recession is actually housing investment. So the biggest predictor of negative real GDP growth in the year leading up to recessions is actually a weak housing market. As we said at the beginning of the video, that makes sense. If you're not buying a new home, you're not going to be buying all the stuff that comes with buying a new home. So the big weakness that we've seen in the housing market over the past year is really likely to slow the economy down. So you're probably thinking, okay, all of this housing weakness could be behind us, and now people are going to start to buy homes, and that's going to stimulate the economy. That could very well be the case, and that could stimulate the economy. It could push the stock market much higher. But the counter argument against this is that buying conditions for housing is actually almost at an all-time low. That level similar to the ones we saw during the Volcker period in the early 1980s, when inflation was almost at 20% and interest rates were almost at 20%. And this is a chart that we showed in one of our premium articles at gameoftrades.net. You can see this survey, which is basically what consumers see as good or bad buying conditions for housing, that only improves after a recession, right? Recessions are the gray bars here, and you can see these buying conditions really surge. They really recover after a recession or during the recession. And so once buying conditions surge, that's when you can expect a real housing recovery that can drive economic growth, it can drive stock market earnings growth, and it can really drive a new economic boom. So as we discussed earlier, housing drives the business cycle and it drives S&P 500 earnings. This is a chart that shows you the relationship between existing home sales and earnings. Now, it's not a perfect relationship. It's definitely not a perfect correlation. As existing home sales are negative, as they're contracting below that zero line, you tend to see earnings contracting. And as existing home sales are trending higher, as people are buying homes, you tend to see earnings be positive. And it's one of the biggest predictor of earnings, at least in our models, leading S&P 500 earnings by around 10 months. Now, there are exceptions like 1995 here, and that's something to note, where existing home sales were declining as the Federal Reserve was tightening, but the Fed never triggered a recession. They were able to ease monetary policy, and the recession never played out, and stock market earnings were able to actually hold up. Now, if we pay attention to what the housing market is currently telling us as a leading indicator of stock market earnings, it says that with the decline in existing home sales that we saw in late 2022, we should see around a 28% decline in S&P 500 earnings. Now, the S&P 500 price be simply computed by multiplying earnings with the price to earnings ratio. So how much investors are willing to pay for each piece of revenue multiplied by the actual revenue. So the S&P 500 PE ratio right now is at 25. So that's historically elevated. It has been higher in the past. We saw trailing 12-month PE ratios at around 30 back in 2020 as investors were anticipating and pricing in a big economic boom with all the stimulus that came in after COVID. If we assume that PE ratios stay at 25, but that earnings decline by 28% as home sales are currently predicting, well, that would simply mean a 28% decline in the S&P 500 from current levels. Now, that's not our target for the S&P 500 over the next 6 to 12 months. You can check out our website if you want to know what our target is for the S&P and all the other assets that we look at. But at least that's what the housing market is currently predicting if you just follow this model, which again is not perfect and has some clear flaws. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to click on the like button and subscribe to the channel. Now, in the meantime, I wish you good luck on your trading and see you next time.